Bringing you the latest in tax credit news, this is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the April 11, 2023 podcast. I am super excited to be discussing this week's topic. I say that because today's podcast is one that we have worked for many years to see come to fruition. And it's not writing the podcast. It's about helping ensure that certain developments happen outside of Novogradac that we could report upon within the podcast. And the topic, of course, is the accounting method known as proportional amortization. On March 29th, the Financial Accounting Standards Board, also known as FASB, issued Accounting Standards Update number 2023-02. This update expands the ability to use proportional amortization to all income tax credits. This Accounting Standards Update number 2023-02 is important to all investors, syndicators, financial institutions, and publicly traded companies who invest in income tax credits. The update affects all income tax credits, including historic tax credits, new market tax credits, and renewable energy tax credits. And within renewable energy, think of investment tax credits such as known as ITC, and the production tax credit known as the initialism PTC. Our podcast episode last week did focus on the effect of the FASB update on renewable energy tax credit investments more specifically. If you haven't listened to last week's episode, please be sure to tune into that. Now, why is this FASB update so important? It's because it broadens the applicability of the proportional amortization method to all tax credits, which puts them all on a same level footing. Previously, proportional amortization, as many listeners know, was only available for low-income housing tax credit investments. Now, the proportional amortization method of accounting, if you're not familiar with it, it allows an investor in tax credits to gradually pay down the initial cost of the investment in proportion to the realization of income tax credits and other income tax benefits. And most notably, the amortization expense that you generate as you're amortizing down your investment is recognized below the line as a component of income tax expense or benefit. That's commonly referred to as the geography problem of some tax credit investments, where the expense is above the line, but the tax credit is recorded as a benefit below the line. And it solves that geography question or issue. Now, the tax credit community has long advocated expanding proportional amortization to all tax credit investments. Back when proportional amortization was created as a concept for long-lasting tax credits, there was also an effort to expand it then, but it was only narrowly adopted for low-income housing tax credits. Novogradac's GAAP accounting working group helped lead this advocacy effort to expand the ability to use proportional amortization. And we did that in part by collecting input from our members and then providing analysis and recommendations to FASB. Now, this FASB update is a great first step to expand proportional amortization method to all tax credits and to begin leveling the accounting playing field for all tax credit investments. I say great first step because additional changes are still needed. The guidance does open new pathways for accounting reporting when it comes to new markets, historic, and renewable energy tax credits, but we believe that FASB should slightly modify the eligibility criteria so that more tax credit investment structures can qualify. We'll talk about that more in a bit. Now, my guest on today's podcast is probably not a surprise. It's my partner, Brad Elphick. Brad leads the GAAP working group and is one of Novogradac's experts on this issue. You may also recognize Brad from his previous appearances on Tax Credit Tuesday, when he's discussed new markets tax credits, the global minimum tax, and, of course, his efforts to expand the ability to use proportional amortization beyond the low-income housing tax credit. In today's episode, we'll discuss FASB announcement, implications for various types of tax credit investments, next steps for investors, as well as developers, as well as additional guidance that's needed. Now, there's a lot to discuss today, so if you're ready, let's get started. Brad, welcome back to Tax Credit Tuesday.
Thanks, Mike. Appreciate being here and I love the excitement on the topic in your introduction. It is definitely exciting developments.
No, it's definitely a big, big win. And thank you so much for all the great work you have done with the GAP working group in order to make this a reality. And also, I'll thank you in advance for the great work you'll continue to do to expand the guidance to apply to more structures.
Absolutely. Stand on the shoulders of many that came before and were part of this effort. As you mentioned, it's been a long time coming. So glad to see it finally take this first step as you mentioned.
Now, it's definitely been a long time coming, and a lot of hands didn't make light work. A lot of hands made it possible to get it through. So if you could quickly and briefly explain to our listeners what specifically was updated in the guidance. When I say updated in the guidance, there was the guidance that applied to only multiples of tax credit investments, and then they issued this updated guidance. So what was changed?
Yeah, that's a great question. And obviously, the biggest change is the expansion to all tax credits. And one that you didn't mention were unknown future tax credits. And that's the beauty of the expansion to all tax credits is before it was specifically limited to a certain tax credit. And there were efforts to make sure that they didn't specifically limit it to other tax credits in this expansion. So we're happy that they appreciated that nuance. And so the expansion is available to the tax credits you mentioned, as well as some that, are currently being discussed, possibly, and others that we don't even know about yet. So we're fortunate to have that. But the proportional amortization method, the update really just uh, much of the guidance is unchanged, except for the expansion, and we'll be talking about why that's important as well. But one of the good takeaways about that is that we have this tremendous amount of experience of applying proportional amortization to the low income housing tax credit investments, and I think a lot of that experience and understanding can be transferred as we're considering how to apply it uh, to these other tax credits as well. So the expansion was a great thing. There were some additional disclosure requirements that were added, um, and I think that most, even those that use it for FlyTech already, won't see them as necessarily overly burdensome, and includes information that they're disclosing anyway. Those disclosure requirements were more optional requirements before, and they've now really kind of codified them as a requirement now. I think it really is an effort to help the users of financial statements understand better what these uh, different types of tax credit investments are achieving and what the purpose of them is. And so I think it gives the preparers opportunity to explain that cohesively. And then there were some other little changes here and there, and that we'll talk about in a little bit more detail that kind of apply to certain tax credits, but not others. But expansion was definitely the biggest update. Uh, but as you mentioned, there's more changes that we would like to see be made in the future on this.
So I mentioned in the introduction that the GAP working group, which you lead, has been advocating for an expansion of proportional amortization method for quite a while now. And one of the reasons why we had Novogradac formed the GAP working group was to give the tax credit community a platform for addressing this issue to expand the use of proportional amortization method of accounting. And I mentioned in the intro that this method of accounting helps with the geography question as to income tax expense and tax benefits. But if you could explain to our listeners a little bit more about the geography question and other benefits of using proportional amortization method of accounting.
I think there's really kind of two, if you well, we're trying to boil it down, I think there's really kind of two major benefits that are accomplished by being able to apply the proportional amortization method. First, as you mentioned, was the geography issue. Having to record the expenses above the line, what made other tax credits that had to do that less attractive than the low income housing tax credit, which was able to essentially net it below the line. And so as we all know, there's a certain amount of capital out there to be invested. And so if there's anything that can be done to put the different tax credits on a level playing field, I think that we all believe that that's a positive for community development tax credits as well as other tax credits as well. And so by eliminating or providing an avenue to mitigate the geography issue, I think the investors are seeing that as a big positive. And I think you will see, as we'll talk about kind of the specific tax credits, there's a lot of investors that are looking at trying to find ways to ensure that they meet the criteria to be eligible to use the proportional amortization method, because the geography issue is so important to them. The above the line, below the line impact on their financial statement typically becomes more important in harder economic times. And I think that some of the momentum that this new project got was as a result of that. It really just kind of highlighted the impact that these tax credits can have if they are required to be recorded above the line. So the geography issue is a major driving factor in terms of the excitement that investors may have in trying to use proportional amortization. But you and Nat actually talked about this last week in your podcast, that there's also the simplicity factor when you're looking at proportional amortization method. As I mentioned before, we've been using it for LIHTC for a long time. Many tax credit investors invest in multiple credits. And so those that were investing in LIHTC were also investing in others, and they were having to use other methods of accounting to record their non-LIHTC investments. And I think that just really highlighted the difference between the different accounting methods and the simplicity that the proportional amortization method brings. In some of these, they may have found ways to achieve similar results as what the proportional amortization method achieved, but it was a much more difficult method when it comes to renewable energy tax credits. A lot of investors use the hypothetical liquidation of book value method, HLBV. HLBV is almost kind of like everyone cringes where they having to implement that. A lot of investors mentioned that was something that really attracted them to the proportional amortization method and made them excited about the expansion to those other tax credits.
So the FASB update expands proportional amortization method to all tax credits. I say expands, but I probably should say expands eligibility to use proportional amortization method to all tax credits. And I add that eligibility point because there are 5 criteria that a given investment has to satisfy in order to use the proportional amortization method. And those 5 criteria essentially remain unchanged, which is a central area that we want to do additional work, is to get some of these criteria to be slightly modified. But if you could outline for our listeners what those 5 criteria are that a investment has to satisfy in order to be eligible to use proportional amortization. And I would note to our listeners, you have to satisfy all 5 of the criteria in order to be eligible.
Yeah, that's exactly right. I can always tell those that are familiar with proportional amortization when they hear of this topic of expansion, because they think that just means that you can use it for any tax credit investment. But as you mentioned, even LIHTC had to meet these 5 eligibility criteria to be able to actually implement the proportional amortization method. So just real quickly going through them, the first is that it's probable that the income tax credits allocable to the investor will be available. The second is that the investor does not have the ability to exercise significant influence over both the operating and financial policies of the limited liability entity underlying the project. Third, and this is an important one, substantially all of the projected benefits are from income tax credits and other income tax benefits. Fourth, another important one, as we'll talk about, is that investors' projected yield based solely on the cash flows from the income tax credits and other tax benefits must be positive. And then finally, the last one is that the investor is a limited liability investor in the limited liability entity for both legal and tax purposes, and the investor's liability is limited to its capital investment.
So thank you for listing the 5. And I'll just note that the first 2 and the 5th one are generally able to be satisfied across all tax credit investments. The first one being that it's probable that the income tax credits will be allocable to the investor. Obviously, investors aren't going to be investing in tax credit transactions if it's not probable that the income tax credits will be available. So that's fairly manageable across all different types of tax credit investments. The second one is the investor does not have the ability to exercise significant influence over the operating and financial policies. And that significant influence, that's one that is all a function of what the partnership agreement and other arrangements are, and that's manageable. And then the fifth one is the investor is a limited liability investor and then limited liability entity. And that's obviously just a function of the structure. So it's really the third and the fourth one that you mentioned. The third being substantially all of the benefits are from income tax credits and other income tax benefits, which basically means there's some amount of your benefits that can't be from other areas, which is namely cash. So when you're looking at your substantially all test, you have to look at how much cash benefits you're projecting to get. And then the other is the fourth one being the investor projected yield based solely on the cash flows from the tax credits and tax benefits is positive. So I think of it as the sub-all test, the substantially all test. And for those of you that work in new markets tax credit, this is a different substantially all test. And then the projected yield being positive test. So sometimes in the course of the podcast, I know we'll talk about the substantially all test and the projected yield test. So I just wanted to emphasize those two as being the critical ones of the five that will be the distinguishing factors in terms of which types of structures will be eligible to use proportional amortization and which ones will not. So with that bit of background, let's turn now to the various federal income tax credits and the issues each may have in meeting all five requirements. And I'll focus the discussion on federal income tax credits as opposed to state income tax credits and those structures. If we get sufficient emails and tweets and the rest about state income tax credits, and we'll do another podcast on that, but there's only so much time today. And in terms of looking at the various federal income tax incentives, I figured the best place to start is with what I'll call the easy one, which is the loan vesting tax credit, because it was already using proportional amortization and investors have already become comfortable meeting those five criteria. So what would you say to me if I'm a low vesting tax credit investor and I'm wondering, does this new FASB update even impact me? Do I even need to bother reading the new ASU?
The short answer is yes, always. Anytime there's an update, you want to make sure that there's nothing that kind of change the assumption that you've been using. And the GAP working group really wanted to make sure that anything that was proposed or considered to expand it to all tax credits didn't harm the ability for LIHTC investors to continue using proportional amortization. And I think that investors will find that there really aren't any changes that create any additional hurdles. As I mentioned before, disclosure requirements have been added, and there are specific requirements that will have to be included in all of the financial statements. And those disclosure requirements are for any tax credit for which you have elected to use proportional amortization. I think that one of the things I didn't mention before in terms of the update, it was a very important factor in this discussion, is the election to use proportional amortization and whether you had to use it for all tax credits investments or if you could elect on a tax credit by tax credit basis. Unfortunately, the FASB in their update gave us the most flexibility by allowing investors to elect on a tax credit by tax credit basis. And based upon which tax credits an investor elects to use proportional amortization will dictate which disclosure requirements apply, and that they'll essentially only apply to those for which they're using proportional amortization. And as you mentioned, we're going to focus on federal income tax credits. One addition that was not one that was widely supported was the addition of the word income in front of tax credits and other benefits. And so it makes it more apparent that it can only apply to tax credits that offset income tax. And then there were some very nuanced pieces of guidance within proportional amortization method related to LIHTC and for LIHTC investments specifically that actually weren't using the proportional amortization method. And they've since moved that guidance to other subtopics where it fits better so that the portionalization guidance that now exists is really silent about LIHTC investments specifically, and that it's more focused on how to use portionalization method for any tax credit. So those are really the only kind of changes that may impact LIHTC investors. So I think for most, there's a sigh of relief upon the receipt of the final ASU that there really weren't any impacts to their ability to use portionalization.
So I did want to emphasize your one point where you said the election can be made on a tax credit by tax credit basis. And I just want to distinguish a tax credit by tax credit basis to a tax credit investment basis. So it's within, say, all locally tax credits, not within particular locally tax credit investments that you might make. Correct?
Yep.
So let's turn now to new markets tax credits. So what would you say are the next steps for investors interested in adopting proportional amortization for new markets tax credits? And just thinking aloud here, new markets claim over 7 years, localized tax credits, you claim credits over 10 years, and it's technically 10 years, spillover years, so it's technically 11. With localized tax credits and with new markets tax credits, most of the investments, there's not a significant amount of cash flow expected. So the substantially all and projected yield requirements 3 and 4 don't seem like they're particularly significant hurdles for most and new market tax credit investments. However, there are some hurdles, or at least a hurdle. So maybe you could talk about that.
Yeah, there's definitely a major hurdle for new market tax credit investors. And it is something that was added to the accounting standard that wasn't included originally. It was silent on the issue. But the addition of 1 or 2 sentences really changed the way that new market tax credit investors were looking at their ability to use proportional amortization method. And that was the addition of language that essentially stated that if their investments are being consolidated, then they're not allowed to use a proportional amortization method. When that came out in the exposure draft, I heard from a lot of new market tax credit investors because many current investors do consolidate. And so where they thought, okay, we're going to be the credit that can most easily implement this, because as you said, we can meet the 5 criteria, we believe, pretty easily, similar to how LIHTC can pretty easily meet them. So we don't have those concerns about sub-all and the projected yield or the positive yield requirement. But this consolidation hurdle really is kind of resetting how new market tax credit investors are thinking about implementing proportional amortization for their new market tax credit investments. And I think what we're going to see and have already seen and talked with some of our clients, it is a discussion about, are there different structures that they can implement so that they do not conclude that they have to consolidate their investment. There are examples out there of those kinds of structures, and I think you'll probably start seeing investors really focus on finding ways to structure their investments similarly as others have that don't consolidate. For those who are not new market tax credit investors, but maybe a CDE or a qualified business, may be wondering, you may see a slightly different structure with some investors going forward than you may have experienced in the past. We're trying to work through some of those questions. The GAP working group is looking at that. But for new market tax credits, there's not as much concern about the 5 criteria being essentially unchanged. It's really this addition of the consolidation prohibition.
Thank you for that. And I should probably note to our listeners, you can become members of the GAP working group. Just email Brad Elphick. We'll include his contact information in the show notes. So we talked about the 10-year low housing tax credit. We talked about the 7-year new markets tax credit. Now let's talk about the 5-year historic tax credit. So what are some top concerns or considerations for historic tax credit investors?
Well, it's been interesting. I think that many historic tax credit investors have been fairly comfortable with the accounting of their investments before the expansion of proportional amortization. There wasn't a whole lot of push by the historic tax credit industry in terms of expanding. However, as I mentioned, there's a simplicity factor in the attractiveness of proportional amortization. And I think what we'll probably see are historic tax credit investors looking at, okay, I'm investing in things other than historic tax credits. If I also invest in LIHTC, I'm using proportional amortization method. I may be investing in renewable energy. Do I want different accounting methods for all of them? Or do I want to try to simplify it and use proportional amortization for my historic tax credit investments as well? And I think if that does end up being the direction that they head, then I do think that they will need to look at the five criteria a little bit more closely, similar to what we'll discuss with renewable energy tax credits. Some of the tax structures require certain amounts of cash flow in them. And that's where some of these substantially all in positive yield requirements can really kind of come up. I think that historic tax credit investors will be looking at it mainly from a simplicity standpoint, but we'll also have some additional hurdles that new market tax credit investors that are eligible won't necessarily have.
Yeah, thank you for that. I would observe that the historic tax credit is generally analyzed by tax attorneys slightly differently than new markets and ultimately tax credits as to the profits test, and also the way in which historic tax credit or just investment tax credits in general, including renewables, the way they get allocated to investors based upon profits versus loss allocations is one of the drivers behind that different test, or that, maybe a more expanded test, which does lead to historic credits, and also talk about renewables having a greater portion of the yield to an investor being cash flow. And that's one of the ways that as investors are looking at trying to expand and qualify, they'll be focused on expecting less cash flow, such that they can get a positive yield from their investment on the tax benefits alone, as well as getting such all their benefits from the tax credit. And there is a bit of an irony here in the sense that with higher interest rates, there's more of a yield spread, if you will, that allows an investor to exclude the cash flow and still show a positive yield on investment alone. So that is a benefit of higher interest rates. Obviously, there's so many detriments to higher interest rates. I'm not saying it's a good reason to have high interest rates, but it is a factor that works to maybe see temporarily a lot more investors qualifying. And it also means that, when interest rates do come down, which I expect they will in the coming, 12 to 24 months, that, some investments, some structure that used to qualify may not qualify anymore as investors change their equity pricing and the rest. But maybe we should move on to renewable energy credits. We did talk about renewable energy credits last week. So I figured I would just check with you, Brad, and say, I want this podcast to be comprehensive, and we can't really be comprehensive without talking about renewable energy tax credits as well. But maybe just add, any points that you might want to add to what we discussed last week with our partner, Nat Ing, and or, point out a few aspects of what we discussed last week that are particularly significant.
Yeah, I think that when it comes down to renewable energy tax credits, there's a huge amount of investment in this. So this one, renewable energy tax credit investors are very interested in the ability to use proportional amortization. As you and Nat discussed last week, there's a lot of focus on the simplicity of the proportional amortization method compared to the current method of using the HLBV method of accounting. While the results of the two may be similar to some investors, the simplicity really would, I think, push them over the edge in terms of choosing the use of proportional amortization. And so if they can overcome the hurdles of the third and fourth criteria that you mentioned, the substantially all criteria, the positive yield criteria, I think that you will start to see a lot of renewable energy tax credit investors use proportional amortization. And there's a lot of ongoing discussion. As you mentioned at the end of the podcast, there's a lot of hope that there's a path forward for renewable energy tax credit investments to meet these different criteria by making some structural changes to fees and other aspects of the structure, so that ultimately they are able to meet the 5 eligibility criteria.
So, Brad, as we've discussed quite frequently over the last 2 weeks, even getting lots of calls from investors, syndicators, banks, and other public traded companies that are, trying to assess whether their investments can qualify for proportional amortization. So what advice are you giving them?
Yeah, ultimately, there needs to be some analysis about whether or not they're eligible to use the proportional amortization method. Not to beat a dead horse, but it goes back to the 5 criteria first, and then their ability to meet those criteria. And so we've been talking to clients related to those, and as we were just talking about renewable energy clients, been talking a lot about substantially all of the positive yield criteria. And so I think that ultimately, investors, others will need to determine if they're eligible to use proportional amortization. This is similar to what LIHTC investors had to do initially when proportional amortization was originally created. And we participated in a lot of those similar analyses. We're starting to see more of that now that the ASU is out. Related to that, I think there's going to be a hard look, or there should be a hard look at the current structures that are being used, tax credit investment structures. As we've mentioned, we believe that there can be some tweaks to those that achieve similar economics, but also fit within the framework of the current guidance. And I think if they're able to get to a point where they're comfortable with those changes, I think that you'll see a lot of investors use proportional amortization. So the 5 criteria and structuring is kind of really where I think I would recommend most investors, others focus on right now. And as you mentioned, there are efforts by the GAP working group to make changes so that maybe some of these hurdles aren't as high in order to meet. I think that a lot of investors are looking at what can I do now based upon what's available. We understand and support future efforts, but this is what we have now. So how do we structure these tax credit investments to meet the different criteria and overcome these hurdles, whether it's the 5 criteria or, as I mentioned, for new markets, consolidation. There's different aspects of the guidance that each tax credit investment will have to analyze.
And I would suggest to our listeners that because that you work through the 5 criteria and you end up finding you don't qualify, and or you have to change your investment structures in ways that you prefer not to in order to qualify, to please join the GAP working group to help financially support efforts to further expand the types of investments eligible. I do think there's a certain draconian aspect to the ways in which 3 and 4 can be applied, the substantially all and the positive yield requirement. So I do think that, the better reporting method would be to have slightly expanded requirements for 3 and 4. But we don't have them yet. It will take a little bit of time to get those through, but I'd encourage listeners to join the GAP working group.
And Mike, one other thing I would add to in terms of advice to investors is, as we mentioned before, there's an election that can be made on a tax credit by tax credit basis. And this is where I think investors will have to decide whether or not the juice is worth the squeeze, depending on the size of their tax credit investment portfolios. You may find that some choose not to elect the proportional amortization method for certain tax credits because it's not worth the analysis and they're comfortable with the method of accounting that they're currently using. I do think that the analogy of whether or not the juice is worth the squeeze is an important consideration in which tax credits they elect to use the proportional amortization method.
I guess I would also suggest that if they're looking at whether to make the election or not, they'll have to address questions about how, if you make the election, how it applies to current and pipeline developments. And we're not going to go into that on this podcast, but that is something you can reach out to Brad for, because he's done a lot of work in that area with clients and is doing a lot of work now to help advise as to the different approaches to addressing that question from an accounting perspective. You can outsource that work we're happy to have you outsource it to us. So as with any accounting standards update, there are effective dates regarding when the new standard can be applied. So Brad, if you could explain the effective dates for ASU 2023-02, and you can touch briefly on the transition methods.
Sure.
Don't go into them in lengthy detail.
Right.
We'll go down a rabbit hole.
Right. As you mentioned, there are some effective dates. These were created similar to how the original proportion amortization method guidance were implemented. The effective dates for public business entities for fiscal years beginning after December 15th of 2023, so this year. For all other entities, they don't become effective until fiscal years beginning after December 15th, 2024. However, and this is something that many are interested in, early adoption is permitted. And that was true for LIHTC before and remains true for this new guidance. And I think there were a lot of bets of whether or not the final ASU would come out before March 31st or after March 31st. Because by coming out before March 31st, it allows, for example, calendar year end entities to early adopt for the first quarter if they're preparing interim statements. So for some, that was seen as if they could elect into and use a proportion amortization, they wanted to use it as soon as possible. And so this early adoption method is permitting them to use it for their first quarter interim reporting. Then, as you mentioned, there's always transition methods, and there was discussion at FASB of which ones they would allow, and they ended up allowing you to choose between two: the modified retrospective transition method, and then just the retrospective transition. So there are two, and it really deals with an assessment of whether it will apply to investments based upon when the date they were entered into, or based upon the beginning of the earliest period presented. As you mentioned, we're just kind of touching on it briefly here, but in advice to investors and preparers, it would be to look at your financial statements and determine probably which one is the easiest to implement for your situation. There will definitely be some analysis by preparers related to which transition to use.
So Brad, we spent time talking about the considerations from the standpoint of an investor, syndicator bank, and a publicly traded company, from obviously the GAAP perspective and why they want to qualify and how they qualify and the rest. Now, say I'm a developer. If I'm a developer of state tax credits, if I'm running a qualified active loan community business seeking subsidized new market tax credit financing, if I am developing an historic building, if I'm installing a solar array, if I'm that project level developer / business owner, what should I know about these rules, and how might the fact that this recently passed affect me and the financing that I'm seeking to receive through tax credits?
Well, I think as a developer, probably the thing that you're always concerned about is the structure for which that will be used to bring in this capital in exchange for these tax credits. And so for low-income housing tax credits, as we mentioned, there's very limited changes, and I don't think really any of those will impact the investment structures that are being currently used. So for LIHTC developers, I would be surprised if there's much change, and so there's probably little concern from that group. Moving to new market tax credits, I think that similarly, there will probably be fewer changes seen by a developer or a borrower that is receiving the new market tax credit financing. And so I think that those structures, any changes will kind of happen outside of what impacts the developer or business owner. For historics and renewable, though, I think that those are the developers that are probably most interested in what impact this will have on those investment structures. As we mentioned, if a investor wants to use proportion amortization method for historics and renewables and be able to meet the substantially all in the positive yield criteria, they may implement some different structuring components to their investments. And ultimately, my question would be, well, how's that change my economics in this transaction?
That is the right question.
For LIHTC new market, though, I'm guessing that's going to be very little, but for these, it could change it. And ultimately, in order to get comfortable with that change, you'd want to understand those impacts on economics. So I think it's a little early to tell what the overall impact will be at this moment, but it's something that kind of investors are working through. They're going to have to consider how that's going to impact their competitiveness in the market as well. It will be interesting to see how that develops in terms of the way the transactions are structured.
Yeah, I guess I would like to emphasize the point that all things being equal, if you're a project developer, this guidance, should lead to, more investors. And once again, all things being equal, it should lead to better tax equity pricing, with the exception of local tax credits, because that one hasn't really changed very much. But to the extent that investors are able to use forced amortization, or at least some investors in the other types of tax credits, it should mean that from their standpoint, it's they reported in a way that's more attractive, so they're more interested in investing. Once again, all things being equal, that should be a positive effect on average equity pricing. And I keep saying all things being equal because things are not equal. Interest rates are rising, inflation, yields have to go up, and all the rest. So it's not suggesting that equity pricing is going to go up where it is now. It's just when you think of all the various factors, global minimum tax, the book minimum tax and all the rest, that this is one factor that is positive. I mean, it's positive enough to offset all the others, but it is directionally positive.
Yeah, and I would say that when we started this most recent push to get it expanded, there was a lot of excitement about being able to bring in investors who had been saying no to certain tax credit investments because of the accounting. And so, as you said, all things being equal, we would hope to see now those investors being able to step into these markets. And so we're going to have a lot more diversity, you would think, in the types of investors that are out there making these different tax credit investments.
And then obviously it also takes time for all this to work its way through as well.
Right.
So many other confounding factors. I'm not trying to tell our listeners that they're going to see higher equity pricing tomorrow.
Okay.
So hopefully I put enough caveats around it, to not get those emails. Anything else you wanted to say on the topic, Brad? Maybe you could mention some of the other ways in which listeners can learn more about the portion amortization question.
Sure. I think really I encourage everyone to consider joining the GAP working group that are interested in this issue specifically. It's not the only issue that the GAP working group plans to address, but it's definitely one that is focused on continuing. As we mentioned at the top, this was a good first step. We think it can still be improved. And the good news about that is that FASB even acknowledged that there could be improvements and potentially another project. So we're encouraged by that. It became very apparent quickly that this current project was very limited to just whether or not to expand. So we do believe there's an opportunity to engage with FASB and improve the guidance so that it is more inclusive. So if you have questions about it, that's a great place to be, to tune in, to listen, to add your voice. The benefit of the GAP working group, especially as it relates to this project, is that we're not focused on one tax credit. We're focused on an accounting issue by all tax credits. And that was a little bit different than our other working groups that are typically focused on a specific tax credit. So the diversity in voices, I think it was really helpful. And we would love to have more of those participants as we work to, make, hopefully, get changes that improve the proportional amortization method and its overall implementation by different tax credits.
And just to let our listeners know that it meets monthly, and the next meeting, it's next week, right?
Actually, the next meeting will be Wednesday, the day after this podcast.
Oh, okay.
Is released. Yes.
Okay. So if you're listening to this on Tuesday, make sure you email Brett right
That's
away.
That's right.
If not, there'll be the next meeting will be in May. So reach out to Brad before the middle of May.
And, because this impacts all the various tax credits that we have conferences for, I fully believe that this will be a topic that will be discussed. So we have several different coming up. Renewable is coming up in May in San Diego, May 18th and 19th. And the New Market Tax Credit Conference, our spring conference, is June 8th and 9th in Washington, D.C. So I'm sure there will be a panel on this issue, or at least a topic within a panel on these issues here.
Yes, and you'll have lots of Novogradac professionals there that you can go and talk to on the side.
Yeah, there's more than just me that understand this issue.
So thanks for all of that, Brad. And to our listeners, I will include Brad's email address in this week's show notes for anyone who wants to follow up with him. And Brad, please do stick around for our off mic section of the podcast, where I get to ask you some fun off topic questions and get your words of wisdom beyond tax credits, or at least beyond directly tax credits. And then also to our listeners, next week's podcast topic is another must listen to podcast, particularly for multifamily rental housing developers. Next week, we're going to discuss 2 HUD mortgage insurance programs that are helping developers finance their construction rehabilitation developments. Namely, we're going to be discussing HUD's Section 221D4 program. That's for construction and substantial rehabilitation, as well as HUD's Section 223F program, purchase or refinancing of existing multifamily rental housing. We at Novogradac have been getting a growing number of calls from developers about the Section 221D4 and 223F programs over the last several months. It's due in large measure because of increasing interest rates, which are causing developers to look for alternatives to conventional loans. They're looking for loans that have comparatively more favorable interest rates as well as repayment terms. So if you're unfamiliar with these 2 HUD loan programs, you'll certainly want to tune in. I'd also note that if you have a 221D4 or 223F loan, you should still tune in, because we're going to discuss certain HUD requirements that many HUD borrowers are not aware of. And in fact, one key deadline for borrowers just passed on March 31st. Borrowers who missed that deadline and fail to rectify it might find that they're unable to get HUD financing for future developments. So be sure to tune in to next week's podcast to learn more. My guest next week will be my partner, Tiffany French. We'll discuss what you need to know about 221D4 and 223F loans. We'll talk about how to qualify for those loans. We'll talk about how to maintain compliance with HUD requirements once you borrow money under those loans. If you have any particular questions you'd like us to answer in the podcast, please email us at cpas@novoco.com and email us right away, because we'll be recording that podcast shortly. Now we've reached our off mic section, where I ask our guests some off topic questions to get their words of advice and words of wisdom. So Brad, I have 3 questions for you. The first one, what advice would you give to someone looking to advance their career?
Yeah, that's a great question. I think that there's a couple different things that I would suggest. The first is never assume there's nothing more you can do. I've felt that some that have felt like, oh, this is all I can do in this role. And I believe that those who kind of advance their career the most are always looking for more to do beyond what maybe they had given. And I think that's a good quality, because employers obviously have more that they can delegate and give down. And if there are employees that are looking for that, I think that that's a positive for those employees' career. The other is avoid complacency. I think oftentimes you can get comfortable in what you know. And I think you really have to kind of be able to step out of that comfort zone and not get complacent with the way that you're doing things. Importantly, too, I think, is to define your why. Why do you want to advance your career? not only professionally, but personally. What benefits do you think that will provide? Life is short as we all know. And I think constantly focused on your why, and it may change, but focusing on your why, I think then you can really kind of craft your career advancement to really kind of meet those goals. Um, I'd also say communication is big. As accountants, some of us are not the A type personalities, and find it maybe a little bit more uncomfortable to communicate. But I think being able to tell others what you want, and also for them to tell you what they want out of your career, I think is always helpful. And then the last two I had were be patient. As I tell my kids, they see what I have accomplished, and I tell them that they're not going to be able to start their job day one and walk out of there doing the same thing I'm doing now. That it takes time. And I think that in this generation, there's a lot of instant gratification, and that comes in your career too. Uh, so I would definitely advise to be patient. But then the last one is to be grateful for what uh, you are able to do. Uh, I find those that are grateful just have a greater appreciation for the benefits that they are receiving, and the progress that they are making, and want to uh, be able to serve others. And I think that ultimately helps with advancing in their career.
Well, those are great points, and they're not even really just advancing your career points. They're about
Right.
how to lead a good life.
There's a lot of similarities. We spend more time at work, I think, than we do anywhere else. So we might as well uh, blend them in.
No, I enjoyed all your various points. It's hard to identify one that's more stiff than the other. They all work very well together. So thank you for that.
Yeah, one of them wasn't being concise.
Oh, that's funny. So my second question is sort of a recurring theme on the podcast in this part of the off mic section about productivity. Is there a habit that you would suggest that listeners add to their daily routines to increase productivity?
Yeah, I talked about defining your why as being important. When I said that, that was the big why. Like, why am I doing this? What do I want out of my life? Those types of things. I think you can do it on a much smaller scale too, by setting a reasonable goal for the day. There's been plenty of days where I've woken up and it's just like you just start going and you get pulled in whatever direction the day takes you. But I think really kind of defining what you want to accomplish that day at the beginning of the day. I know for me, it helps me stay more focused on that task. And so as there are interruptions, I either decide, okay, I'm going to allow that interruption, or I'm going to push it to the side and deal with it after I've met my goal for that. Uh, but just as important as I think those kind of daily, just little goals are, um, I think it's also important not to get so focused on whether you met that day's goal every day, because there's going to be many goals that we don't meet. But I think just the habit of setting that goal each day, being okay with that, okay, I didn't necessarily meet my goal today, but guess what? There's tomorrow. And I have the chance to set a new goal tomorrow and meet that. I think for me, that kind of brings some freshness to every day, because things can get monotonous and repetitive. And I think by asking yourself what that goal is each day, I think helps avoid some of that.
So I have a third question for you, and that is there a podcast or television program that you've recently started listening to that you find particularly interesting or intriguing or entertaining?
You know, um, I other than this podcast, obviously, but I noticed you didn't even limit the question as you normally. But I found myself listening to a lot of political commentary, and sometimes too much. And my interest in a certain podcast kind of fluctuates, as with any kind of political commentary. After a while, they repeat a lot of
Yes.
what they're saying. But I think it's interesting. to hear some of it because they're much more focused on it, on kind of in the details that I'm not able to get into and appreciate. And as you know, there's a lot of political aspects to our job here, as players in investment tax credits. And I really enjoy understanding how things really work. There's the talking points that everyone hears on the news or wherever it may be, but you and I have been able to see it in real life and see what really happens. How things are really done in Washington or at the state level or whatever. I'm just fascinated.
Okay.
I'm not great at being a politician, but I enjoy seeing how it works.
So
But I didn't give you an answer, but it's mainly been political podcasts.
okay, that's fine. That's fine. I appreciate that, and I definitely cycle through different themes of podcasts and the rest. But I've recently become really big with Audible, so I listen to lots of sort of books, and that's a great way for me to occupy my time when commuting and things of that nature. So thank you again, Brad. Thanks for joining me on the podcast again. And thanks again for all your work on behalf of the GAP Working Group and Novogradac and all of our clients to help see divorce amortization get expanded, and look forward to you being successful in your efforts to get further expansions of the use of divorce amortization. And to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes. You can find related links referenced in this podcast in our show notes at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.